Missing your required minimum distribution can trigger a 25% penalty, yet most retirees still feel confused about when, how much, and from which accounts to withdraw. If you've ever worried about taking too much, too little, or paying unnecessary taxes, you're not alone. In this video, we'll break RMD rules down into 5 smart, practical moves that help you stay compliant, reduce your tax bill, and make your retirement savings last longer. Know your required minimum distribution, start, age, and calculate your first withdrawal correctly, because missing this step can trigger one of the steepest penalties in the tax code. As of recent rules, most people must begin RMDs at age 73, though this can increase to 75 depending on your birth year, so you need to confirm your exact requirement based on your date of birth. Your first RMD must be taken by April, one of the year after you turn the required age. But every RMD after that must be taken by December 31 each year. For example, if you turn 73 inches 2026, you can delay your first withdrawal until the 1st of April 2027. But then you will also have to take your 2027 RMD by the 31st of December 2027, meaning 2 taxable withdrawals in 1 year, which could push you into a higher tax bracket. The amount is calculated using your prior year-end account balance divided by an IRS life expectancy factor. So, if your IRA was worth $200,000 on December 31 and your factor is around 26.5, your RMD would be about $7,547. If you fail to take the full amount, the penalty can be up to 25% of what you should have withdrawn, although it may be reduced to 10% if corrected quickly. The practical move is to log into your retirement account early in the year, confirm your provider's RMD calculation, and schedule the withdrawal automatically so you never miss a deadline. Plan your RMDs alongside your overall tax strategy to avoid unnecessary tax spikes, because every dollar you withdraw is treated as ordinary income and can affect much more than just your tax bill. RMDs can push you into a higher marginal tax bracket, increase how much of your Social Security becomes taxable, and even raise your Medicare Part B and Part D premiums through IRMA surcharges. For example, if you already have $60,000 of income from Social Security and a pension, and your RMD adds another $20,000, that could move you into a higher bracket or trigger higher Medicare costs 2 years later. One effective strategy is to do partial Roth conversions in the years before RMDs begin, especially in lower income years like early retirement, so you reduce the size of your traditional IRA and future RMDs. Another move is to spread withdrawals throughout the year instead of taking a lump sum, which can help with withholding and budgeting. You can also have taxes withheld directly from the RMD, which is often easier than making estimated payments. The key action is to project your income annually, ideally with tax software or a financial advisor, and decide how your RMD fits into the bigger picture instead of treating it as an isolated event. Use qualified charitable distributions to reduce the tax impact of your RMD if you are charitably inclined, because this strategy allows you to satisfy your RMD without increasing your taxable income. A qualified charitable distribution, or QCD, lets you transfer up to $100,000 per year directly from your IRA to a qualified charity once you are age 70.5 or older. The key detail is that the money must go directly from your IRA custodian to the charity, not pass through your hands, otherwise it becomes taxable. For example, if your RMD is $10,000 and you donate that amount via a QCD, that $10,000 does not show up in your adjusted gross income at all, which can help keep your tax bracket lower and reduce the taxation of Social Security benefits. This is often more beneficial than taking the RMD and then claiming a charitable deduction, especially if you take the standard deduction. It can also help you stay below thresholds that trigger higher Medicare premiums. The practical step is to contact your IRA provider early in the year and request a QCD form, specify the charity, and ensure the transfer is completed before December 31, so it counts for that tax year. Consolidate and track all retirement accounts to ensure you meet every RMD requirement, because the rules apply separately depending on the type of account, and it is easy to miss one. Traditional IRAs can have their RMDs aggregated, meaning if you have 3 IRAs, You can calculate each RMD, but withdraw the total from one account if you prefer. However, employer-sponsored plans like 401(k) generally require separate RMDs from each plan, so you cannot combine them the same way. If you have an old 401(k) with $50,000 and forget about it, you could miss an RMD and face penalties, even if you took distributions from your IRA. One smart move is to roll old 401(k) into a single IRA before RMD age, which simplifies tracking and gives you more flexibility. Also note that if you are still working and do not own more than 5% of the company, you may be able to delay RMDs from your current employer's plan, but this exception does not apply to IRAs. The practical system is to keep a simple spreadsheet listing each account, its year-end balance, the calculated RMD, and whether it has been satisfied, and to review it at the start of each year. Set up automatic withdrawals and withholding to stay compliant and avoid penalties, because consistency is your best defense against costly mistakes. The IRS does not accept excuses for missed RMDs, and even though penalties can sometimes be reduced, the process requires filing additional forms and explaining the error. By automating your RMD, you remove the risk of forgetting a deadline. For example, you can instruct your custodian to distribute your full RMD in monthly payments of $1,000 if your annual requirement is $12,000, or take it quarterly, or as a lump sum early in the year. At the same time, you can elect to have federal and state taxes withheld, such as 10% or 20%, which helps you avoid underpayment penalties and simplifies your tax filing. This is especially helpful because RMD withholding is treated as if it were paid evenly throughout the year, even if taken late. Another benefit of automation is better cash flow planning, since you can align withdrawals with your living expenses. The key action is to log into your account or call your provider, set a recurring distribution schedule, confirm the withholding rate, and review it annually to adjust for changes in income or tax law.